Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. M&A activity this year has been relatively robust, which may be a little surprising considering the rising rate environment and general instability in markets. But we're being warned that the next 12 months are looking fragile. We spoke this time last year to Sandy Mack, Head of Corporate at Corrs Chambers Westgarth, when the independent law firm released its M&A 2023 report. Now it's time to see what's in store for 2024. Sandy, welcome back to Fear and Greed.
Thank you very much for having me, Sean.
Given the economic circumstances, have you been surprised by the amount of activity this year?
You know, Sean, I have really been surprised. Now, I should just clarify that our survey each year relates to what we call public mergers and acquisitions, so for listed company takeovers. And very much to my surprise, this year we have had the same number of deals as we had in the prior survey period, which on an overall basis is about the highest number of deals in over a decade. Now, I don't know that it felt like that to many market participants. There was a lot of uncertainty during the year. There was a lot of nervousness about where the market was heading. What we did observe that was interesting was that all of this, a significant portion of this activity actually occurred kind of towards the very end of our survey period. So in about the last couple of months, we saw a spurt in activity and a lot more transactions that were announced, which is what has contributed to the final numbers that we've got this year.
So what do you think was driving it?
I think part of that was a degree of relative confidence. I think that in order to do M&A deals, you do need some stability, you need some confidence about where rates are going and how much it's going to cost to finance transactions, and you need confidence about inflation and consumer appetite. There is a sense, I think, at about, August that these things had stabilized. Some market participants thought that we were going to end up with a soft landing and that rates in the US had definitely peaked and weren't going to go up any further. So my view is that is what contributed a little bit to the activity in the latter half of the year, and a sense that really you can't sit on your hands doing nothing for an indefinite period of time. At some point, you're going to have to start deploying the capital that you've got. And the reason I think that it is a little bit more fragile than the stats might suggest is even since we pulled the survey together, at the very last minute, I was writing up about interest rate rises in Australia, which we hadn't seen in a while. There's been geopolitical tension in the Middle East, which is of itself could contribute to rising oil prices, which then affects inflation, which affects interest rates. And so I do think that there are lots and lots of factors at play in the macroeconomic and geopolitical sense that can easily turn things. So I'm probably less robust about the coming 12 months as I ordinarily would have been based on the numbers.
Okay. I mean, let's take a few points within that, and even if we're looking backwards partly, but then what that means going forward, there seems to be a bunch of privatizations. So we've seen M&A, that's probably the wrong way of putting it. There has been some privatizations, but actually overseas companies are buying local companies, and so the local companies, either the parent company end up on the ASX or they move away from the ASX, for example. Has there been more of that than normal?
So I think that the number of what we call P2P, so public to private, where an ASX listed company is taken over by a private company and no longer remains listed on the ASX, is about broadly similar to what we had last year. Right. We have a number of transactions that were what we call script for script deals, where you roll over your existing shares in the target company into shares in another listed vehicle. But the vast majority were in fact cash deals where you acquire the target that's listed on the ASX and you delist the entity. That's not an unusual phenomenon. That is the very definition of public M&A, is that you take a public company private in many instances. What is slightly worrying, though, is that our equity capital markets just haven't come back in the way that we have had in the prior years. So the number of initial public offerings or IPOs on our ASX has been down quite significantly. And what we as deal makers like to see is a good pipeline of IPOs to replenish effectively the companies that are taken out of ASX listed environment. I think interestingly, that's part of what is contributing to some transactions being voted down or threatened to be voted down. And the Brookfield Origin one is an interesting example of that, because there are some shareholders out there that don't have a better alternative to put their capital into. So even if you get a great return and a good cash outcome, there may not be a more suitable alternative for you to reinvest your capital gain into.
Okay, so the Brookfield EIG Origin one is a really good example because Australian Super has a big role in that as the largest shareholder. Generally, the super funds, what sort of role are they playing in this M&A activity? Are they the kingmakers, or do we oversell that a bit?
I think major shareholders this year have been the kingmakers, and there have been a number of transactions in which that has proven to be the case, including one which our firm worked on called the Albemarle proposed takeover of Liontown Resources. Major shareholders really are proving to be a very significant influence because they have got very particular views on what they want. And if you take the Origin Energy case, for example, historically, a lot of the superannuation funds have followed proxy advisors' recommendations and don't always have their own internal investment teams. But Super hasn't done that. They are taking a very specific internal view on value. They are informing themselves as to what they want to do and whether they want to vote in favor of it. And therefore, that I think does make it very, very persuasive and very influential for other shareholders as well.
Stay with me, Sandy. We'll be back in a minute. My guest this morning is Sandy Mack, Head of Corporate at Corrs Chambers Westgarth. You mentioned Albemarle Liontown Resources. A couple of things on that. Is most M&A in the mining sector, the resources sector, the very broad resources sector, shall we say?
Yes, and that is definitely the case. Our M&A market in Australia has been buoyed by the strength of our energy and resources sectors. So mining and metals and oil and gas are the vast proportion of transactions in this space. Of all of the resources, if you like, gold is the most active, but lithium and critical battery minerals have seen a huge jump. So an increase in lithium deals, for example, a market increase, we observed that last year. And that's effectively what's kept us really occupied and busy for the last year in M&A.
Okay, so in terms of that, in the mining, resources, energy sectors, how much of the buying and selling is done by, or the buying, I suppose, is done by international bidders?
The vast majority of transactions actually this year have been by Australian bidders. We have seen an increase in the number of foreign bidders compared to prior years. I do think a bit of that is really just the Aussie dollar getting a little bit cheaper and therefore Australian targets being better value. It was hard to do foreign deals into Australia during COVID because it was hard to do the diligence and to get boots on the ground. And I think the trend line of an increase in the number of foreign bidders is just reflective of the fact that we are now returning to the state of the market that we used to have prior to COVID, where we had quite a dominant influence on foreign bidders because Australia has historically always been a net importer of capital. However, Australian bidders continue to dominate our public M&A space, and they still constitute the majority of buyers. I think what is more interesting is the composition of our foreign bidders is very heavily skewed towards what we call the Five Eyes nations. And as a result of that, countries like the UK, the US, Canada, and New Zealand, those are the countries that constitute the largest majority of the foreign buyers. And it's not surprising, particularly in very sensitive sectors like lithium, for example, that these would be the logical foreign buyers if there is going to be a foreign buyer.
Okay, so going forward, the outlook you've explained is going to be fragile. What about, are there certain areas, and lithium is a good example with the Inflation Reduction Act in the US, that opens the door potentially to more M&A, notwithstanding the outlook is more fragile? I suppose the question really is, particularly out of the US and maybe out of China, is there big spending packages that could affect our mining sector?
I think the election next year in the United States is going to be incredibly interesting to watch, and its impact on M&A across the globe, really, and not just Australia, will be something that we shouldn't underestimate. The Inflation Reduction Act, which you mentioned, is a significant contributor to M&A and activity in that ESG space in the US, and Australia hasn't had the same benefits from that because we don't have an equivalent package. A lot of capital has gone into the US as a result of the IRA. If for any reason that were to change as a result of a change in president, I think that will completely turn ESG investment upside down and on its head, and we might start to see a significantly greater percentage of investment in that space coming into Australia, including into places like, battery metals and critical minerals.
Are deals more complex these days, Sandy? I mean, everything seems more complex, but I must say, when there's so many deals going through, are they more complex? More need for Corrs?
I do think they are more complex. And the reason I think they're more complex is not just because we love complexity, but it's because right now, I think the bid-ask spread on acquisitions is still a bit wide. If you think about the fact that interest rates are increasing and therefore cost of capital becomes greater, the prices at which you want to buy stuff, if you're a bidder, have to be lower in order to be able to make the margins and returns that you want. On the other hand, you still have sellers that are working off multiples from prior years, which have been at record highs and where debt was very, very cheap. And the result of this is that it doesn't take a lot to make a deal difficult to do. A little discovery in diligence, a little shift in market sentiment, and that may mean that a deal's not a good fit for someone. Complexity, therefore, is all about ensuring that we get structures that give the bidders the protection that they want on downside risk, but also give sellers the ability to maximize value, to participate a little bit longer in a transaction. And then, as I said, now we also have a whole bunch of other stakeholders like major shareholders who have very different views from basically their target boards and the buyers as to what's good for them. And they'll continue to take a very independent perspective on these things. And so we have to cater now for so many stakeholders. And the structural complexity on transactions, I think, is about trying to address a series of dynamics that allows everybody to meet their demands or their needs in a way that will enable or facilitate a deal to get done.
It means you're going to be very busy, Sandy. Thank you for talking to Fear and Greed.
Thank you very much for having me again, Sean.
That was Sandy Mack, Head of Corporate at Corrs Chambers Westgarth. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.